Good afternoon, ladies and gentlemen. I am Karthikeyan, moderator for the conference call. Welcome to the Q1 analysis call of Arisinfra Ltd. As a reminder, all participants will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on a touch-tone telephone. Please note, this conference is recorded. I would now like to hand over the floor to Ms. Purvangi Jain from Valorem Advisors. Thank you, and over to you, ma'am.
Thank you. Good afternoon, everyone, and a very warm welcome to you all. My name is Purvangi Jain from Valorem Advisors. We represent the investor relations of Arisinfra Solutions Ltd. On behalf of the company and Valorem Advisors, I would like to thank you all for participating in the company's earnings conference call for the first quarter of the financial year 2027. Before we begin, let me mention a short cautionary statement. Some of the statements made in today's earnings call may be forward-looking in nature. Such forward-looking statements are subject to risk and uncertainties, which could cause actual results to differ from those anticipated. Such statements are based on management's belief as well as assumptions made by and information currently available to the management. Audiences are cautioned not to place any undue reliance on these forward-looking statements in making any investment decision. The purpose of today's earnings call is purely to educate and bring awareness about the company's fundamental business and financial quarter under review. Let me now introduce you to the management participating with us in today's earnings call and hand it over to them for their opening remarks. We have with us Mr. Ronak Mohurpia, Chairman and Managing Director, Mr. Bhavik Khara, Whole-Time Director and Chief Financial Officer, and Mr. Srinivasan Gopalan, Chief Executive Officer. Without any delay, I request Mr. Ronak to start with his opening remarks. Thank you, and over to you, sir.
Thank you, Purvangi. Good afternoon, everybody. It is a pleasure to welcome you all to the earnings conference call for the first quarter of the financial year 2027. In the interest of some of the people who may be new to the company, let me first start by giving you a brief overview of the company, followed by the financial highlights and operational highlights for the quarter under review. India's construction ecosystem continues to present a large structural opportunity driven by sustained infrastructure investments, urbanization, and increasing formalization of procurement processing. However, the industry still remains highly fragmented with limited technology integration and operational inefficiencies across sourcing, execution, and working capital management. Aris is focused on solving these challenges by building an integrated execution and procurement network powered by technology, data intelligence, and disciplined operations. Aris is a tech-enabled construction materials and services company focused on simplifying procurement and execution across India's infrastructure and real estate ecosystem. We operate an asset-light, network-driven model that integrates sourcing, contract manufacturing, logistics, technology, and project execution into a unified operating platform. Today, we serve over 3,400 customers through a network of 2,200 plus vendors across 23 states and union territories, with more than 82% repeat order contribution, reflecting the strength of our execution capabilities and customer relationships. Our business is built across 3 complementary segments, which together create a scalable and capital-efficient ecosystem. The first segment is our B2B supply business, which acts as the entry point to the network. Through this business, we provide developers and contractors with efficient procurement solutions across different construction materials. This segment is relationship-driven and helps us build transaction scale, pricing intelligence, and deeper customer engagement across regions. The segment contributed around 37% to our revenues in Q1FY27. The second segment is contract manufacturing, which has now become one of our key growth and profitability drivers. Under this segment, we secure production capacity through exclusive long-term partnerships with manufacturing plants without owning the assets ourselves. This allows us to benefit from manufacturing economics while maintaining an asset-light structure. During Q1FY27, this segment contributed nearly 53% of revenues, underscoring its growing importance within our business mix and strengthening our supply capabilities. The third segment is our services business, operated through the developer as a service or DaaS model. Under this offering, we manage the entire project lifecycle for developers, including procurement, project execution, funding coordination, sales, and collections. During the quarter, we secured a new DaaS mandate worth 650 crores from a leading developer in Mumbai, further strengthening our project pipeline. As a result, our execution portfolio expanded to 10 active projects, with gross development value under execution increasing to over 1,800 crores, providing strong long-term revenue visibility. What is important to understand is that these three segments are deeply interconnected. The B2B supply business helps build customer relationships and network density. Contract manufacturing improves supply control and profitability, while the services business drives higher margins and long-term engagements. Together, they create a powerful operating network with strong cross-selling opportunities, improving operating leverage and increasing customer stickiness over time. With this, I now hand it over to Mr. Bhavik Khara, the whole-time director and CFO of our company, for the financial highlights for the period under review.
Thank you, Ronak, and good afternoon, everyone. Let me take you all through the financial highlights for the period under review. For the quarter under review, the revenue from operations stood at 291 crores, registering a strong growth of 37% year-on-year. EBITDA for the quarter grew 68% year-on-year to 31 crores, with EBITDA margins improving by 191 basis points year-on-year to 10.49%. PAT stood at 20 crore rupees compared to 5 crores in the corresponding quarter of the previous year. Alongside the profitable growth, we continue to improve our operating efficiencies and maintaining a strong balance sheet. Our net working capital days further improved to 56 days compared to 66 days as of March 2026, demonstrating our continued focus on efficient working capital management. Our balance sheet remains robust with net debt to equity at just 0.02x, providing ample financial flexibility to support the future growth. On the return matrix front, the ROE stood at 17.16%, ROCE stood at 10.61%, reflecting our continued focus on profitable and capital efficient growth. Thank you, everyone. With this, now I hand it over to Mr. Srinivasan Gopalan, our CEO of the company, to give operational highlights for the quarter under review.
Thank you, Bhavik. Good afternoon, ladies and gentlemen. Coming to the operational highlights for the quarter under review. Our contract manufacturing business maintained strong momentum during the quarter, with revenues growing 84% year-on-year, and now the contribution from this segment alone increased to 53% of the overall business in Q1/27. We delivered approximately 8.65 lakh metric tons of construction materials during Q1/27, supported by increasing utilization across our manufacturing partnerships and continued customer demand. Another key highlight during the quarter was the continued scale-up of our asphalt business. Revenue from the segment increased to 53 crores in Q1/27 from 30 crores in Q4/2026. The number of customers transacted also increased to 38 from 28 in the previous quarter, reflecting strong customer adoption and growing acceptance of our asphalt offering. Our DaaS platform, developer as a service business, also continued to scale meaningfully during the quarter. We secured a new DaaS mandate worth 650 crores from the Vazwa Group in Mumbai, significantly strengthening our project pipeline and market presence. As a result, our GDV under execution increased to 1,800 plus crore compared to 1,250 crore at the year-end Q4/2026, providing strong revenue visibility over the coming years. Customer retention also remained a key strength of our platform. Repeat orders improved to 82% compared to 78% in Q4/26, reflecting increasing customer confidence in our execution capabilities and the strength of our long-term relationships. Overall, these developments reinforce our strategy of building an integrated technology-led construction ecosystem. As we continue to expand our product portfolio, manufacturing partnerships and DaaS platform, we remain focused on delivering sustainable, profitable growth while maintaining capital discipline. Overall, we believe Aris is steadily evolving beyond a traditional construction materials business into a scalable network-led platform where technology, execution capability, and ecosystem relationships together create long-term value and sustainable growth. Thank you.
Thank you, sir. Ladies and gentlemen, we will now begin the question and answer session. If you have a question, please press star and one on a telephone keypad and wait for your turn to ask the question. If you would like to withdraw your request, you may do so by pressing star and one again. Ladies and gentlemen, if you have a question, please press star and one on a telephone keypad. The first question comes from the line of Mahesh Polani from Go Quarter. Please go ahead. Mahesh Polani, your line is unmuted. Please go ahead with your question. So there seems to be no response. We have the next question from Akash Chowdhury from EC Equity.
Yeah, am I audible?
Yes.
Yes. So congratulations on a good set of numbers. I really liked it. So just wanted to know, like a few questions. So I think we did a EBITDA of around 10.5% and very well executed as per last commentary you said. So is this the new baseline we can set, maybe in the range of 10.5 to 11% going forward?
Yes, I think it's important to understand what is driving this margin expansion. It's primarily a mix of increase in revenue from our contract manufacturing and DaaS segment, and they're carrying meaningfully higher margins than B2B trade. And their combined share moved from about 46% to 63% as of Q1 FY27, and that's the main lever behind the EBITDA margin, expanding. And we expect this to sustain for the next few quarters.
Got it. So on a follow-up of that, so contract manufacturing as we are scaling, so as what I understood from the businesses, let's say there are three segments versus the B2B supply. So we use those data and maybe kind of convert those few customers and sell them through contract manufacturing based on demand and so, and maybe convert few of them into DaaS services. Am I right?
Yeah, I would say that is one part of the story. It doesn't necessarily move from one step to the other. There are many B2B supply customers that we start serving from our contract manufacturing segment, but these three operate as individual segments as well, because in B2B supply, we do almost all of the materials. In contract manufacturing, we do only stone aggregates, ready-mix concrete, and now asphalt as well.
Got it. Okay. And what part of the contract manufacturing, basically on the utilization front, how much headroom is still left, and maybe are we continuously doing more capex or more product where we are kind of have good margins, just to get a go forward basis understanding of how the things are left?
So based on the annual capacity that we have and the revenue possibility, we are at a utilization of somewhere around 65 to 70% as on Q1 FY27. So there is significant headroom for growth, and we are looking to add more capacity this year as well, not by adding more deposits, but recycling deposits, the current deposits.
Okay, so what do you mean by recycling deposits?
So whatever deposits we had given to lock in the multi-year capacity, which was about 90 lakh metric tons annually, we will be recycling those deposits, not adding more deposits, but using those same deposits to add more capacity. And we look to add about 2 million to about 3 million annual capacity this year in the next 2 quarters.
Okay, and what is the base right now? Like what is the current capacity?
It's about 9 million annually.
So 9 million would typically become around 11 million tons without any capex or any kind of deposits.
Got it. Got it. So basically this kind of gives us a hint that we are going into a huge demand cycle and we are kind of catering to those, right?
Correct. Correct.
Got it. Got it. And one or two more last questions. So historically, I think Q1 and Q2, any like for most of the infra companies is kind of lean, right? So how would you take about it for Aris? Anyways, we are going to cater a huge demand, which we can already see. And the expectation also is like kind of we are about to grow 35 to 40%. So are we kind of increasing that guidance, or is it the same? Or what about the lean quarter versus the overall year? I just want to get a flavor of that.
Yeah, we would like to stick to the same guidance. It's more of a strategic play. The demand is huge. Obviously, our scale is negligible compared to the market size, but we will stick to the guidance that we have shared, about 35%-40% annually.
Okay. Quarter 1 and 2 being the lean quarter, and 3 and 4 being the
Absolutely.
more heavy quarter.
Yeah. Annually, we continue with our guidance of 35%-40% growth. Typically, the first 6 months is around 40% of our sales, and the next 6 months are around 60% of our sales.
Got it. Thanks. I think that's all from my side. I'll come back to that. Thank you so much.
Thank you.
Thank you. We have the next question from the line of Agastya Dave from CAO Capital. Please go ahead.
Thank you very much for the opportunity. Am I audible?
Yes.
Good morning, everyone. I have 3 questions. One is, as you mentioned, in the answer to the previous participant's question, that the margin improvements are coming because of the mix changes. Was there a substantial mix change between like sequentially quarter-on-quarter?
Quarter-on-quarter, not much. The revenue contribution remains almost the same.
Right. Sir, is there any particular quarter where we see a quantum jump in the mix, from, let's say, because you have a fairly decent order book on that real estate vertical that you have,
Yes.
where you are offering the services, right? When will that ramp up, and when will we see substantial contributions to the EBITDA margins coming from that particular vertical?
Yeah, it's more of a sustained growth journey rather than a 1 month or a 1 quarter spike. These projects normally run a course of around 18-24 months. It will be spread across quarters. We are already recording the revenues and profitability each quarter. It's going to be more of a sustained growth. You're already seeing the numbers that we're delivering.
Great, sir. You are fairly asset light on the fixed asset side, but on the receivables and inventory side, I was just wondering, as the scale of the company goes up, how do they scale? Is there any like significant increase in ROEs and ROCs that you're expecting? If so, what is the path from the balance sheet point of view?
Yeah, absolutely. I mean, if you look at the receivables also, at the end of quarter 1 last year-on-year comparison, we've grown approximately 37% in terms of revenue. The receivables grew just 15%. Receivables grew at less than half the pace of revenue, and that discipline held even as we grew every single quarter over the past year. That's actually visible in our net working capital days, which has reduced from about 97 in the last quarter to about 56 days now.
Okay.
You know, we don't expect the receivables to grow as much as the revenue, and that's the, you know, that's something that we focus on when we actually look to scale in the coming quarters.
Sir, is this approximately 55-60 day number sustainable for the entire year?
It will fluctuate a little bit quarter-on-quarter. Usually our quarter 1 is slow on inflows, but we still manage to kind of, you know, have good numbers. I think steady state, we look to be somewhere between 60-70 days on a net working capital cycle days. However, the focus will obviously be to improve it further.
Great. If you can really improve that, then obviously, I mean, the return ratios will really start looking fairly nice.
Absolutely.
One last clarification, sir. Over the years, we have had derivative losses, and also there have been a number of quarters in which we have recognized some credit losses. What is the nature of these losses? Now that there is a substantial change in the business model and there are other verticals which are also contributing, do you see the credit losses to be a recurring thing? For example, you have added tier 1 clients now, right? My guess would be that chances of credit losses would decline. What's your take on it, sir? What is the expectation that we should build in?
If you look at the lifetime revenue that we have done, it's close to about 3,800 crores-4,000 crores. The ECL that we have provided for till date is about 22 crores. It's just a little over 0.5%. You know, as management, we believe that's a very good number to have. It's very controlled. We, you know, we just want to factor in for the uncertainties that may arise in the future. We are in a tough industry. All of these credit losses, we want to take a conservative approach, and that's what we've been doing, and we will look to do the same in the future. Having said that, the quality of receivables has significantly improved in the last couple of years, and that's been the focus. That's what we've been doing, and we've added more and more, stronger names to our customer list. And we just take a conservative approach when it comes to expected credit losses.
And then generally, whenever credit loss does happen, what is the loss given default from the customer?
Sorry, I didn't get that. Can you repeat it?
So suppose there is an event where there is a credit event from the side of the customer, and you are owed, let's say, hypothetically 100 crores, and you have to somehow go for liquidation, like the company is going for liquidation. So in the worst case scenario, what is the loss that we incur? Loss given default from the end of the customer, LGD?
Typically, the outstanding, let's say the customer outstanding is about 25 to 50 lakhs. Whatever we can recover, and the rest is a complete loss. So, that's how.
So also in some of the
Generally, is
cases,
it like 50%, sir, 75%, 80%? How much do you recover?
No, it depends on the ability to recover. I mean, we start the legal process. In some cases, we've been able to recover 25. In some cases, we've been able to recover over 80% also. And most of our new receivables are also insured. So we have recovered a heavy sum from insurance as well. So this is the approach that we take for these receivables. Yes.
Understood. Okay. Thank you, sir. Thank you very much, sir, and great quarter, sir. All the best.
Thank you so much. Thank you.
Thank you. We have the next question from the line of Manish Kera from Swastik Investment. Please go ahead.
Yeah. Thank you. Am I audible?
Yes.
Yeah. So first of all, congratulations on the very good set of numbers in the last 4 quarters. So my first question is a little bit long question, so please bear with me. So on the previous calls, you have talked about supply chain financing. So can you confirm as to how this works for your payables? What is the normal credit period that you get from your suppliers? Am I correct in assuming that when we make payments to these players through supply chain financing, we end up paying interest from our end as well? What is the interest rate and the number of months for which the interest is payable, if at all any? Also, do we get any discount from our suppliers in the event we pay them early? So to give you an example, let's say we pay them immediately through supply chain financing and say get 1% discount. I am assuming that maybe 1% is the same interest that you would end up paying to the supply chain financing guys for securing credit. So if you can please explain this entire piece.
Yes. We've spoken about supply chain financing limits that we avail. Predominantly how it works is exactly how you said. We partner with platforms or financial institutions. They will pay our vendors on day one, and we get a credit period of around 90 days to make those payments. Now there are 2 things here. One is the interest payment that is borne either by us or by the vendors sometimes. That's a point that we continuously negotiate, and that keeps on changing. It's fluctuating. But how we look at it and how we actually plan is much more important. It's not always about the interest cost that we can save or the discounts that we can get. We put cash flow it is our topmost priority. So we want to reach a stage where we conserve our capital. We keep the capital for events which can arise due to delayed payments, and we don't want to reach a situation where we are cash trapped. So we factor in the interest cost. We are okay paying the interest cost only to convert this model into more of a less working capital model. And we are in a position where the invested money is making substantial returns to offset the interest cost as well. So this is, I would say, more of a strategy that we have implemented, and we will continue to do so.
Yeah. And just to reconfirm, you said we do get discounts, right? Because we pay our suppliers early through the supply chain financing model.
Yes, there is definitely a possibility of paying the vendors on day one and getting the discounts. Some of those discounts are actually, you are seeing that in our numbers as well. And this is a continuous journey. We will be looking to expand more on that in the coming quarters.
Okay. Thank you, sir. And my second question is, under the DAS model, are we turning into a real estate player? Because isn't it what we do the end-to-end stuff for some of the real estate projects, exposing us to the risks associated with the real estate sector. So for instance, what happens in case of unsold projects for all the raw materials that you've supplied? Do you receive cash only when the units are sold, or how does it work?
No. So first, let me take the second question on when do we get paid? We get paid for the material supplies as and when the due dates are. So if there is a 30-day credit period, 60 days credit period, it comes on time, and it is not dependent on the sale of the real estate. And coming on to your first question, we try to get all the benefits of real estate without 2 or 3 important things. One is, we are not responsible for any regulatory challenges there. So we are not a RERA promoter. We do not, and any monies borrowed, they are all on the developer's balance sheet. So we are not responsible for any repayment. The good part is tying up in the entire life cycle is when we supply material, we know exactly the cash flow situation of the company, and that improves our credit worthiness and also our credit risk that we are taking on that company. So that is exactly what we do. We get the benefits and we reap the benefits, where you can see that the DAS model, the EBITDA levels are at 60-65% without any kind of real estate risk that we take. Other than, of course, being exposed to that industry. I mean, the industry, we are exposed to both infrastructure as well as real estate industry.
All right. So, because you also talked about the sale aspect of it, right? Wherein you do, for some of the projects, the end-to-end work. So, when it comes to sales, right, is there a commission attached to it, or how does that part work? Because for the raw materials part, I understood.
Yeah. So the DAS model operates on 2 things. One is there is a fixed fee which comes every month, and then there is a percentage on the construction, and there is a percentage on sales. So this is how the fees are actually deployed. So that's how the fees come in.
Okay. So all your raw material costs, you would have recovered under the payouts which come under the raw material supplied. Is that correct?
Absolutely.
Is that understanding?
Absolutely.
Okay.
And all the DAS projects are... Yeah, sorry.
Yeah, go ahead, sir.
All the DAS projects, we ensure that there is financial closure on day one. So it is not only the sales dependent construction, also there will be bank loans which are in place on day one, so that the project gets completed. That is of utmost importance for a real estate company.
Got it. So, what would be the maximum amount that we would want to commit, say, to a particular project, under this segment?
So first of all, we do not commit any kind of capital to these companies. We do not lend. Our income is only by way of fees. Our investment is by way of the professionals that we deploy in these projects. So other than that, there is no other investment we have. It is a completely capital light model. So none of the capital is actually deployed for DAS.
All right. All right. Understood, sir. So if you can squeeze in one last question, this is more of a feedback. So you've talked about strong traction, especially in the asphalt segment. Don't you think maybe competition is all ears and this increases the risk of competition, especially say this particular segment? So instead of maybe disclosing sales numbers, we can just say there was strong traction in asphalt segment without disclosing the numbers. I know you guys are the best judge, but that's a thought process because competition is listening definitely.
Point taken, sir. We are also learning, and thank you for the feedback.
Yeah, thank you. And thank you once again for all the good performance that you guys have been doing. That's really commendable.
Thank you, sir.
Thank you.
Thank you. Yeah, the next question from the line of Sanchita from Robo Capital. Please go ahead.
Yes, hi. Thank you for the opportunity. I just wanted to ask, what is our current debt level and what kind of debt can we see in FY27 and 28?
Hi. So our current net debt is about 14 odd crores, 14.5 crores. So our net debt to equity ratio is 0.02x only. In this financial year, we will like to grow this to about 75 to 80 crores and be conservative in terms of our net debt to equity. As we maintained before as well, we would like to keep our net debt to equity at par of 0.5 to 0.6, not more than that.
Okay. And so my second question is regarding the services business. So, so out of our total GDP that we have, what percentage of that do we book as revenue?
So again, ma'am, if I disclose the percentages, probably we will be negotiating hard. The developers will be negotiating hard with us. So we can take this offline one-on-one on what could be the percentage that we draw out of those.
Okay, all right. That's all from mine. Thank you.
Yeah.
Thank you. Ladies and gentlemen, in the interest of time and fairness to all participants, we request you to restrict yourselves to 2 to 3 questions in the initial round and join back the queue for more questions. Next question comes from the line of Akhilesh Rawat from Ridhanta Vision Private Limited. Please go ahead.
Hello. Am I audible?
Yes.
So my first question is regarding the geography mix. So our most revenue is coming from Maharashtra and Tamil Nadu. And despite having presence in like almost 23 states and some 1200 plus pin codes. So like I just want to understand what kind of long-term plan you guys have to diversify this mix, and is there any intentional bias like because of more margin you are getting from these geography, and that's it. That's my first question.
Definitely. I think, the states or the PIN codes is just to give everyone an idea of, how we can scale and how we can diversify. But at the same time, when we look to, when we look at the material supply business, we always focus on areas where we are very, very strong on our supply network. And that's why you see heavy concentration in the region of Tamil Nadu and Maharashtra. That's where we have most of our contract manufacturing plants. And that is where heavy construction work is happening in terms of real estate and infrastructure. So that's why the focus is here, where we can maximize our returns.
Okay, so are there any other states or other geography where you will be focusing more in the upcoming years, like in the 3 to 5 years, you will see that there is a high demand in those areas, and you will try to capture that demand and over the area. Are there any such areas or states?
Oh, definitely.
What's your roadmap for? Yeah.
Yes. We will definitely looking to expand in other regions as well, but that's not a conscious effort or a strategy. We look at the current demand in our current regions. I mean, if you look at just the Tamil Nadu region, crores of tons is the demand, is the market opportunity annually, is the same in Maharashtra as well. And we have barely scratched the surface in both these regions, even with the current scale that we have. So it's not a conscious strategy. It depends on the kind of opportunity that comes across, and we will look to expand further in more regions in the coming few years.
That's great, actually. My second question is regarding this 650 crore dash service platform. So since that business have like 50 to 55% EBITDA margin kind of thing. So now when we will see the 650 crores coming in the quarter, like in which quarter we will see this revenue coming in?
So most of these DAS projects are between 18 to 24 months of completion, and all these DAS revenues are already coming in. So if you see this quarter, around 28 crores, which is approximately 10% of the top line, has come from the DAS platform. So this will follow the pipeline that we have.
Okay, and what kind of visibility do we see in this DAS platform, because it has more margin, and like you have also said that you will maintaining the 11% of a sustainable margin. So what kind of visibility do you have in for the upcoming like financial 27 and financial 28 from this segment? Where do you think this segment will be in terms of mix in our overall revenue mix, apart from those two services like B2B and your construction business?
Okay. So overall, we should be between 9 to 11% of the top line of the company. That is what DAS would be. Number two is what was the other question? 9 to 11% is what we will be gunning for. And given that the revenue would be growing 35 to 40%, DAS would be following the same range.
Thank you. Thank you so much. All the very best for the upcoming quarter. That's it from my side. Thank you.
Thank you.
Thank you. We have the next question from the line of Darshil Jhaveri from Crown Capital. Please go ahead.
Thank you so much for taking my question. Firstly, congratulations on a really great set of numbers, sir. Just wanted to know in terms, we have a really great profitable quarter in Q1, and I think Q1 is usually our slower quarter. You said that margins will be maintained, but ideally, I feel that margins with higher contribution of DaaS and everything coming up, it can keep on increasing, right, sir? What would you see it like this year and next year, sir?
It's hard to commit on, hard numbers, but if you look historically also, the last 4 quarters that we had in the last financial year, we can look at the same kind of growth journey. Quarter one is usually slow. That's not because the demand is slow, but it's just a strategic move, keeping the cash flows in mind. We expect the next 3 quarters also to grow meaningfully. H1 and H2, as mentioned earlier, usually we look at it as a 40/60 ratio, and that's something which we will, kind of deliver in the next 3 quarters.
Okay. Just our profits, again, I'm not saying a number, but would be higher in terms of percentage than what it could be in Q1, right? If our 7% PAT in Q1, then I think towards the end of the run rate of Q4 would be a bit higher than that, right? That would be a fair way to look at it, right? A Q1 growth in profit margins.
We look to sustain these numbers. We are very confident of sustaining these numbers. However, the focus is always on improving the profitability and improving the numbers.
Oh, that's really great to hear, sir. Sir, just wanted to know, DaaS we have, we've gotten quite good orders. Over the next 2-3 years, how do you look at this segment, growing more? I think you are pioneers in it. Do you think other people will start coming into it? Or how do you look at it? There'll be ample of opportunity, all over India about this, right? Could you just, brief on the next 3 years? Can this segment itself be as big as what company is today, or how do you look at it, sir?
Right now, see, we have created an ecosystem for ourselves under DaaS. Wherever there is money requirement, we are able to provide that material management. Those are the 3 mantras under which we go. Currently, we do not see anyone directly competing with us. Of course, competition is always welcome. It keeps us on our toes. The market is huge. The real estate market is huge, and especially the land availability in South, especially Bangalore, Chennai, Hyderabad, that is going to be our main focus. Right now, we are very skewed towards Bangalore and Mumbai. The market is huge, and we would, as I said earlier, 9%-11% of the turnover, we will tag along well with the overall growth of the organization.
Fair enough, sir. Yeah. That's it from my side. Thank you.
Thank you.
Thank you. Participants are requested to restrict yourselves to 2 to 3 questions in the initial round and join back the queue for more questions. Next question comes from the line of Ishit Desai from FOD Family Office. Please go ahead.
Yeah. Thank you for the opportunity and congratulations on a very good set of numbers. Sir, to the previous participant answer, you mentioned that the net debt position as of now is about 14 crore. At the end of the day, we are expecting it at the end of the year, we are expecting it to be around 75 to 80 crore. Given that at 31st March, we were at about negative net debt of about 65 odd crore. And this Q1, and we have added about, say, 75 to 80 crore of gross number of debt, or maybe utilized cash, whichever way it would have been. What gives us confidence that, how actually the cash flow typically works for us to limit ourselves to 75 to 80 crore of net debt? Is that there are more recoveries as we move forward? How do we see ourselves looking at that number?
Yes. The inflows have been very, very strong. In the last financial year, we collected more than about 1,100 crores. We've been doing fantastically well on that front, and you can see the result in the reduction in our net working capital days. Availing such working capital limits gives us more, leeway in terms of the capital at disposal to tackle the 35 to 40% growth that we intend to target year-on-year. So that's the reason the inflows have been very, very strong, and this is not on the back of one good quarter, but also because it is a function of the quality of receivables now that we have on our books.
Understood, Ronak. I mean, I'm just trying to understand that is that Q3 typically are better in terms of collections or larger number in terms of collections, and hence the net debt addition won't be very strong incrementally?
Yes.
Is that right?
Yeah, that's the right way to look at it. Quarter 3 and quarter 4 are meaningfully better in terms of cash flows as well as revenues.
Understood. And just to understand on the ROC and ROE numbers you have mentioned on the presentation, so how exactly have we calculated for Q1FY27? Is it on a trailing 12-month basis for the profitability?
Yes, it is on the basis of trailing 12 months.
And the capital employed as on 30th June 2026, right?
Yes.
Okay, understood. So with this 75 to 80 crore of net debt, so incrementally we will be then deploying about 150-160 crore of capital to generate that incremental 50-55 crore EBITDA we are talking about, right? So that's a higher incremental ROC as compared to what we have done historically. Is that a right understanding?
Yeah, and then when the capital efficiency will come in terms of our receivables get better in Q3 and Q4, the requirement of cash obviously will come down. So the incremental capital required will go down, and hence the ROC will get better in Q3, Q4.
Understood. Sure. And the second question is on the contract manufacturing side. You mentioned that we are likely to increase the capacity from 9 million to 11 million. So if you could help us understand what geography that would be and what materials specifically we are adding capacity.
Yeah, this will be expansion again in the south, Tamil Nadu region, and this will be predominantly in the group category, stone aggregates.
Aggregates, right. Fair. And lastly, on my side before I come back, so on the revenue concentration side, given that working capital receivable is an important aspect of this business, any understanding on, say, a revenue contribution from top 3, top 5 customers concentration, if you could help us understand?
Yeah, the top 10 concentration is about 45 to 50%.
Top 10, right? So
yes, top 10.
That's a reasonably... So fair to assume that none of them are very meaningful in the overall context. I mean, you don't have dependability on one or two guys from a very large...
Absolutely not. I think it's important to understand that the top 10 customers are further spread across multiple different projects in different regions as well. So the topmost customer, it's basically active in 15 plus project sites. So the cash flows are not dependent at a customer level, but at a project level. So it's well diversified even in the top 10 customer list.
And last one, I mean, if I can squeeze in. So on the DAS part, Srini, if you could help us understand. I mean, we understand that in the public forum, you mentioned what's on a percentage of GDV. But if we were to look at, say, traditional sales channel guys or guys who then look at it on a bulk basis, on a sales commission basis, right? What would be the typical commission they would earn? I'm sure, given that we are adding more value, much more value than them, beyond sales, then our percentage would be higher. But a typical industry norm for a bulk sales commission, what would that norm be for a percentage of GDP?
So there are different models that happen, but that is only sales. I mean, I want to reiterate that we are in the entire value chain. So that is very, very different from what they do. The sales channels that are available, they concentrate only on sales. So they do not know the cash flows of the project. They do not know the health of the project. We actually deep dive into it. I just want to reiterate that so for the understanding.
Yes.
Now, coming on to your specific question, the typical sales channels like a Guardians or Anarock were only into sales. They would drop between 2 to 3% as a percentage. And if you look at a Xanadu or something, they would charge maybe 4 or 5%. So that is what they would do.
Sure. So there are precedences of 3 to 5% if we are then taking up a serious problem. Then okay, fair.
No, that is only sales. So please understand in real estate, everything is so interconnected So if someone is ready to pay only 3 to 5% only for sales, we provide significantly large value to these people, saying that we will actually manage your project. We brush shoulders with the promoters. We do not deal with the sales heads. So that is a significant difference. And obviously, the more you go at the top, the more value you keep adding. You're not a vendor, you are a partner to them without having the liabilities of the partner.
That's exactly I wanted to understand, that even if you're not adding value, if you can make 3-5%. Sorry, just completing my sentence and then I'll move on. So that's exactly what I wanted to understand, Srini, is that even without any value addition, if you can make 3-5%, that means there is a case for a much higher percentage.
Much.
Fair. Sure. That's it. Thank you so much, and all the best for the coming.
Thank you.
Thank you. The next question comes from the line of Disha Chordia from Sapphire Capital. Please go ahead.
Hello. Am I audible, sir?
Hello. Yes.
Yes. Thank you so much, sir, for this opportunity, and congratulations, sir, for a very good set of results. Firstly, sir, last time I think we spoke, we were targeting 55 to 60% from contract manufacturing. We're currently at 53%. So assuming we end this year at 55% sort of contribution, can we expect to reach 60% contribution from this segment in the next year? Will that be a fair understanding?
Yes, absolutely.
Hello?
Yes, absolutely. Yeah. We will look to achieve a 55 over 60% contribution in the coming months.
So that would mean our EBITDA margins can easily be 11% for the next year. I know, sir, we're not giving any guidance, but is the direction where we are headed, is that understanding correct?
Directionally, yes. And I think historically we have proven that, we're growing in terms of our EBITDA margins as and when we have improved our contribution for manufacturing as well as DAS. So it's an integrated model. Directionally, yes, that would be correct.
And sir, in the asphalt business, we've seen very good traction. What sort of revenue contribution are we expecting from this business for this year and for the next year?
It's just been about 6 months since we have started this business. We are looking at high value projects in terms of this particular product category. It's a little bit slower during the monsoon because of the rains. We expect the Q3 and Q4 numbers to be meaningfully higher. So hard to put down numbers, but we expect the revenue contribution to be meaningful in this financial year.
Okay, that is very good to hear. And so given this new capacity addition that we're doing, post that, what is the sort of peak revenue can we look at from the current asset base that we have?
It all depends on the utilization. We can push harder, but it's more of a strategic call, and we like to stick to that. Sustainable growth is something that we definitely believe in. Right now we are at a utilization of about 65 to 70%. As on the current capacity that we have, which is about 9 million metric tons, about 900 crore of inventory. Once we add that, we will look to increase and improve our utilization as well, thereby improving our contribution from contract manufacturing as well. So it's an ongoing journey. Hard to put down numbers, but I think directionally we will be improving in terms of our capacity as well as contribution from contract manufacturing.
Okay. And just the last question, sir, from my side. When will this associate company be fully merged, sir, so that we do not have any minority interest? When will that be completed?
Sorry, I didn't understand the question. Can you repeat it?
The associate company, when will that be fully merged with our operations?
Is this a subsidy or the associate company?
The subsidy.
For subsidiary, yeah. So we've actually, I don't know if you can comment on the timelines because it's with SEBI, it's with regulatory bodies right now. But we're trying to push it as from our end, how quickly we can. But it's under process.
Okay. That is it.
The process has already started, and 1, 2, 3, 4. 3 out of the 4 regulators have already cleared it. We are at the last leg. However, the timeline obviously dependent on procedures of the government, so that we won't be able to comment on. But we are at a very advanced stage.
Okay. That is it, sir, from my side. Thank you and all the best.
Yeah.
Thank you.
Thank you. The next question comes from the line of Amit Mehendale from Robo Capital. Please go ahead.
Thank you. So my first question is on the DAS revenue. let's say we book, say, 10 crores of revenue for a certain project. Just wanted to understand how will it spread over, say, 24 months. I mean, I'm trying to understand the lumpiness in the revenue, if any.
No, so honestly speaking, you need to look at the order book. Say the order book is 2,000 crores and it is between, say, 18 to 24 months. So more often than not, it also follows a pattern of 40% in the first 2 quarters and 60% in the next 2 quarters. So whatever the revenue for the year is. So for example, we are at a run rate of, say, 28 into 4, right? 60%, 40% would come in Q1, Q2, and 60% in the second half. So the order book of, say, 1,800, 1,900 crores that we have, which this will get exhausted over the next 24. The fee income coming out of this would get exhausted over the next 18 to 24 months, starting immediately. I mean, it's already started. And then there will be new orders. Yeah.
Sorry to interrupt. So, no, I was saying that, but there are also some milestone-based revenues, right? Because there is I think, a milestone revenue on contract. Yeah.
Yeah, the milestone happens every day. So there is a new slab cast or there is something else that is happening on a daily basis. There is sales that is happening on a daily basis. Plus there is a fixed fee which is just a reflex of time. So there is revenue constantly coming in through DAS across the time frame.
And there is also sales related revenue, and let's say, ballpark, if we take it as 3, 4, 5%, that typically comes, I mean, does that also come on a monthly basis from a revenue recognition perspective?
Everything accrues to you on a real-time basis, and obviously the reconciliations happen at the end of every month with the developer.
Right, sir. And on the sales, if we look at typically, Xanadu's or without taking names, I mean, there are, agencies who are doing sales, and if you look at their debtors, right, I see that their debtors are, they get paid after 6 months, 7 months, 8 months. So how do we tackle that part? The payment cycle is pretty long there.
So the payment cycle could be between 3 to 6 months. You are correct on that. However, there is a huge difference between their debtors and our kind of debtors. In our case, we are adding value on a daily basis. They are appointed for a certain period of time with a target saying that you will sell 20% of my stock and you are out of this. So we are not like that. We are continuously adding value at all sections of theirs, and that's why our debtors' position are far better than theirs.
Typically what we have seen in those businesses, particularly who are purely doing sales, is that there is very little free cash flow, and there is a lot of working capital requirements for their business, and then it generates very little ROE or ROC, and also the cash flow gets stuck. So
yeah, you are comparing two different type of business models, sir. They are sales agents. They are sales aggregators. Their job is that they will actually coordinate with local brokers and then do the sales on behalf of the company. We are not brokers. We are actually going through the entire life cycle of the project. It has got different elements and sales is just one of the elements there. So there is a big difference between what they provide and what we provide. So their aim is to just sell at whatever price. I mean, some indications given with the developer and get on, whether the collections come in, whether the collections don't come in, all of that are not looked into by them. They don't have visibility into all of those. So I think there is a fundamental difference between, and I will not be able to compare and give you a reconciliation on that. They may have their own models. What is their working capital need? I am honestly surprised to know what could be their working capital. What is their revenue model? If they are completely based on only sales happening and collections coming, obviously their debtors will be skewed towards a longer cycle. However, if you have a model where you partner with them, you get X amount of fees on a monthly basis to take care of your working capital. What kind of working capital that you are putting in? Practically nothing.
Sure, sir. Understood. And my last question on the same point is that do we have field staff for doing sales or is it largely a B2B model?
It is purely B2B model, right? For example, if the company on the other side is, say, Arsh Greaves or say Vadwa, right? It's a B2B for us. My client is a Vadwa or a developer like that.
No, when we're selling to the end customer, are we doing B2C, like reaching to the...
Obviously B2C. That is B2C.
Okay. Understood. Okay, sir. Thank you very much.
Thank you.
Thank you. We have the next question from the line of R.K. Malik, an individual investor. Please go ahead, sir. R.K. Malik, your line is unmuted. Please go ahead with your question. So there seems to be no response. We have the next question from C.R. Narayan, an individual investor. Please go ahead.
Am I audible?
Yes.
Yeah, hi. Congratulations on a great set of numbers, guys. One of the ways that it's more a philosophical question. Considering that the DaaS model that you guys follow is fairly differentiated. Since you said that you're involved at every stage of the project with a developer, right from procurement of materials, planning, execution, and then sales. And your read of the whole thing is much better. And also you have a fairly successful and a fairly robust contract manufacturing-led model. If you were to explore a new geography, from a philosophy standpoint, what is it that you would actually use as the selling point? I mean, you would foray into a new geography basis your DaaS strength, or as Ronak mentioned a little while ago, that contract manufacturing presence in a particular state. Considering that both have worked and they've worked quite well, going ahead, if you were to plan a strategy, it would be what? A more DaaS-led model, which would then kind of and see if we can maximize across all revenue streams, which is contract manufacturing and other things as well? Or would you lead by contract manufacturing and then say if I can actually progress into other verticals as well?
So basically, we fire from all cylinders. Okay. So there are contract manufacturing, prospecting for that. So it follows a completely different sales cycle, and the DaaS model follows a completely different sales cycle. The good part is wherever there is a DaaS model happening, automatically we keep looking for whether the vendor is good, the vendor is not good. If the vendor is good, is then when the contract manufacturing happens. On the other hand, where the contract manufacturing is already happening, DaaS model can be an add-on there. So we keep all our options open. We fire from all cylinders, and then the business happens that way.
Thank you. But going beyond Tamil Nadu and Maharashtra, if you were to share some experiences and say which is it that you which has helped you gain more traction between these two? I understand both are explored.
Yeah. So if you look at our contract manufacturing locations, it is Maharashtra and Tamil Nadu. If you look at the DaaS model, it is Karnataka, Maharashtra and Tamil Nadu. So, and as I said, last year our turnover was 1,050 crores. So we have not even scratched the surface. We have the entire of India to explore. We know that we are adding value. We are consistently adding value. We want to be very cautious in our growth. So that's how we will move.
Thank you.
Thank you. We have the next question from the line of Siddhant, an individual investor. Please go ahead. Siddhant, your line is unmuted. Please go ahead with your question.
Hello, am I audible?
Yes. Yes, you are.
Yeah, thanks for the opportunity to ask a question there. Sir, I actually wanted to understand a little more about the DaaS model. So from what I understood, the DaaS model is a highly lucrative segment for you, where you kind of generate really high EBITDA margins of close to 55-60%. From your previous guidance and from what you said in this call earlier as well, I know that you mentioned that this segment is going to stay at around 10 to 11% of your overall top line. So what I want to understand is, like, why not we are trying to scale this up to, let's say, 15 or let's say 20% of the top line, given the dynamics of this business and our mode in this particular segment?
Yes. So it's not just about DaaS. If you look at all the segments, it's not that we don't try to focus on increasing the revenue contribution, but as a guidance, we directionally what we would like for the investors to understand is that we are in a position to sustain a revenue contribution of about 9 to 11% from DaaS and about, let's say, going up to about 60% from contract manufacturing. However, the focus will always be on improving and increasing that. If you consider the growth of around 35 to 40%, we are still growing meaningfully in both of these segments.
Got it. That's nice to know. And so on the top line front, so our guidance is to grow close to 35 to 40% for FY27. And is there any guidance for FY28 and FY29 as well? Like going 2 or 3 years ahead, what's our target?
Historically, we've grown in the last year also at that rate, and we would like to stick to about 35 to 40%, at least for this financial year. And we will look to give more guidance on next 2 years in the coming quarters.
Okay, got it. So that's it from my side. Thank you.
Thank you.
Thank you. Due to paucity of time, that was the last question for the day. I now hand the conference over to the management for their closing comments.
Thank you, everyone. Thank you for joining today, and I hope we have answered all your questions and look for some of you to join us in our journey. Thank you so much.
Thank you, sir. Ladies and gentlemen, this concludes your conference for today. Thank you for your participation and for using Gooseaba's conference call service. You may disconnect your lines now. Thank you and have a pleasant day.